Hi, good afternoon, everyone. My name is Lauren Middleberg. I am Anchor's Membership and Conference Director, and it's a pleasure to be here with all of you today. On behalf of Anchor, I'm really excited to kick off our partner webinar, Hidden Potential, How to Make Your Real Estate Work for You, which is brought to all of us by Scioto Properties. They have a great and really important discussion planned for you today. Before we get into that discussion, I'd like to share a bit about Scioto Properties. For 25 years, Scioto Properties has served as a trusted partner to healthcare organizations in managing their real estate needs. They offer residential financing solutions to support providers in administering care to individuals dealing with disabilities, traumatic brain injury, behavioral health issues, and substance abuse. Scioto Properties is committed to investing and in developing quality healthcare real estate solutions to help providers deliver exceptional care to individuals with specialized needs. I know our presenters will tell you a whole lot more, but let me also thank Scioto Properties for their tremendous support of Anchor. They are a deeply valued Anchor National partner at the gold level. Actually, they've participated in the program since it was created. So, getting right into today's important presentation, I am delighted to introduce our two panelists. First, we have Rick Coley, VP of Acquisitions at Scioto Properties, and Sam Cleaver, Director of Business Development at Scioto Properties. Thank you again to our presenters, and thanks to our members joining us today. Over to you, Rick and Sam.
Awesome. Thank you so much for the introduction, Lauren. Hi, everyone. I guess I'll switch to the next slide. So I am Sam Cleaver. I am the Director of Business Development at Scioto Properties, and I will be moderating today's webinar. And I am accompanied by my dear friend and VP of Acquisitions, Rick Coley.
Thanks, Sam. And thank you all for being here today. And thank you for that wonderful introduction. The topic we're going to cover today isn't one that typically gets talked about enough in the IDD sector. IDD providers are often just simply focused on the people they serve, their DSPs, programming, and compliance, and pretty much that's exactly what you should be. But in the process, there's a significant asset that often goes overlooked, and that's our real estate. And so over the next 30 to 45 minutes or so, our goal is to walk you through what your real estate's actually worth, and how other organizations have put that worth to use, and how to help you think through whether this is the right conversation for your organization at this time.
Thanks, Rick. So before we dive in, I would like to share that if you have any questions throughout our time together, I'll be collecting them in the chat/Q&A, and we'll have Q&A moments in between specific sections of today's webinar. So feel free to ask follow-ups, share what's resonating with you in your particular situation, and so on. So, all right, Rick, let's giddy up.
Yeah. So here's really quickly the 7 things we're going to touch on in this session today. First, we're going to start by talking about the hidden asset many of you are sitting on. That's your real estate. Of course, it's really not that hidden. Obviously, it's typically one of the largest items on your balance sheet. And then we're going to explain what the PropCo, OpCo model is, and the structure of how providers like you separate off in the real estate versus the operations. And then we're going to walk through what a sale-leaseback looks like step by step so you can understand the details of it. And then we'll get practical about what you're able to do and how you're putting that capital to work for you in various ways. We're going to be pretty honest about the risks and to consider as we can, because there are some real risks. And then we're going to close with a quick self-assessment to help you decide if this conversation is worth having for your company at this time. So let's get into it.
All right. So when you think about your organization's most valuable asset, most everyone here would likely agree that it's people. So it's your DSPs, it's your clinical team, it's your leadership, your funders, and most importantly, the individuals that you serve. And that is completely true. However, when we're talking about the balance sheet in particular, the answer is almost always real estate.
Yeah, and so here's what we typically see a lot and when we work with IDD providers that own real estate, right? And a lot of providers are small, started up off small as individuals and have grown into dozens of homes and things like that, and they may own them outright, or they may have mortgages and things like that. And typically, what we're talking about, the largest asset on the balance sheet is really what we're considering is the market value less the book value, less what you've got on your mortgage. So it's really more to that margin that is sort of a combination of the down payment you put on it and the appreciation that you've had over the period of time that you've owned the homes. And then second, that capital that's sitting, that what we're talking about, that working capital that's available to you is typically sitting idle, and it's not funding any growth or your operations. It's not funding new properties oftentimes because it's locked up because it's either a down payment that you have to have, or it's sitting in unrealized appreciation and value from the market. What we've seen in other areas, like in say ambulatory surgery centers, medical office building spaces, or other healthcare sectors, those have all sort of unlocked this value, where IDD space is typically a little behind the curve, and not just IDD. It's some of the sober living and the traumatic brain injury. Those spaces as well are also a little bit behind the curve with this. And so what we're trying to do is show you ways to unlock that and see that it's not a function of if your real estate has value, it's what you want to do with it once we unlock it.
And so I'd say the golden question of today's webinar is certainly this one. So it's, what if your real estate could fund both your facilities and your operations? So just ask that you keep this in the back of your mind as we proceed today.
Yeah, and
all right, so now we're going to talk. Oh, sorry, Rick. What?
No, go ahead.
I was just going to say that now we're going to talk about what your property is actually worth in today's market, starting with market versus book value.
Yeah, and it might be a little more simplistic analysis for some folks that have a PropCo, OpCo, and already are very sophisticated in the real estate. But what we're really talking about is the fair market value of your property as it stands today versus the book value, which is often quite a bit lower than what the market value it is. And so you're seeing a lot of appreciation that's happened. That's really more so even since post-COVID type of stuff, where there's been a tremendous increase in values pretty much around the country, and that presents a really interesting opportunity for providers. And so in this space, we're a company that invests in real estate like this. There's plenty of others that do a lot of do. And one of the reasons that this real estate is so attractive to investors is because if you look at it, it's really government-backed revenue through Medicaid reimbursement models. Now that's subject to SSI, percentages that's really allowable and permissible in the guidelines that are used for that. And so it's also not just the government back, but it's going to be pretty mission critical stuff, right? We're seeing even where they're having cuts in Medicaid and challenges to the reimbursement models, we're seeing this still be the case where these properties are being funded. There might be a slight decline in reimbursement models, but that these IDD properties, even though they're not sexy, right? They're essentially they're low-income housing, affordable housing for folks in need. But they're really attractive to investors as it relates to their long-term revenue stream, and which makes them something that people are looking to invest in, and it's becoming a growing thing. So what we're seeing as a result of the increase in interest in this, and that is, you're seeing obviously there's what we call sort of cap rate compression, where you see there are more dollars chasing after IDD homes. So there obviously cap rates are reducing. So these investors are are looking at lower returns, but there's a limit to where this will lead, because unlike sort of market-based housing, the rental rates cannot increase at will according to the market. They're going to be a function of the adjustments in terms of cost of living adjustments that each state has. So, and the other part of this, that on this last point, is that what's really important in this is for you all to understand what your real estate's worth. And some of that's really obviously just a function of getting a valuation. There's a lot of services out there free of charge, in the case, between your Zillow and your realtor.com and your Redfin. We use, automated valuation models that are called AVMs that are similar, they're a little more sophisticated than that, but that's really where you want to start, is to try to understand what the size of your potential working capital could look like if you were to do a sale leaseback of some kind.
So, Rick, I know that we've been talking a little bit about assets on the balance sheet, but what other things should we be considering when looking at owned versus leased properties?
I think one of the things in terms of smart, generally accepted accounting principles and wise use of, for companies that are well run, I think in this service industry, you'd have debt equity ratios that may want to be a consideration for you buying versus leasing, where lease properties don't hit that. Where if you have mortgages on real estate as you're acquiring real estate, and that's obviously putting upward pressure on your debt equity ratio. I think in this space, it's somewhere around 0.4 to 0.6 or 7 is considered a healthy debt equity ratio for IDD businesses. So getting above or closer to 1 is sort of an indication that there could be an imbalance. And leasing real estate is something that can actually positively impact that and lower your debt equity ratios down. So that's one consideration. Obviously, there's many.
Right. Let's now talk about the structure, because this is the conceptual foundation for everything that we're discussing today.
It really is, Sam. Thanks. The PropCo OpCo model. Obviously, this is just sort of shortened terms for the property company and the operating company. And most of you either have this. If you have multiple properties, you've already sort of set this up. If not, conceptually it still applies. In that, where you think about your real estate, that company or that entity that holds the real estate versus the company that operates and takes care of the individuals in the homes and pays rent to the PropCo or the investor in our case. In some cases where there's acquisitions of stuff, there's separate acquisitions that go on in the M&A world, where the OpCo is purchased by a private equity company, and then you'd have another investing company purchasing the PropCo, because the private equity based companies typically don't want to own the real estate. They'd rather be in leases. So it gives you a number of things happen. You get flexibility for financing. When you're doing PropCo, OpCo, you've got all that property sitting in one entity or in a real estate holding company of some kind. You get some liability protection in that real estate, which is helpful. And then you also get the access to capital should that entity want to, it obviously is going to have a large side of a number of assets in it. And if you wanted to do a sale leaseback or some other function within that company and dealing with all of the real estate, it's a nice, convenient way to access capital in that way.
Love it. And really the bottom line is that this structure is not about giving up control. We more so say that it's about separating two different functions that have different capital needs and different risk profiles, and then optimizing each one. So how do we do that? We ask? No one actually asked me that, but I'm going to tell you anyway. A sale leaseback. I love this part. Rick, let's explain what this looks like step by step.
Sure. So obviously in the sale leaseback, as the operating company, you own the real estate. So or multiple pieces of real estate, whether it's group homes, ICFs, day centers, all of the stuff that all of the real estate that underlies and supports what you're trying to do, taking care of an individual. You look at execute a sale leaseback where you're selling that to an investor. Typically, it's running based upon fair market value of your real estate, but obviously things that impact the purchase price of that is going to be the condition of the home, the terms of the lease, and the financing terms that are out there in the market at the time. So you're selling it to an investor. At the same time, on that sale, you're executing a long-term lease. Typically, it's if the starting point on the lease would be a triple net lease. We have 10 to 20 years. It's really as low as 5 years in some cases, and then you have the kind of renewal options that allow you the control for the length of time that you want. It allows you to control the property without actually owning it, and then you're taking, obviously you're going to get some lump sum proceeds after that from the sale of the PropCo. And you're either going to deploy that in your PropCo itself or in your OpCo. In many cases, it's OpCo, but you're able to do that, and you've got this opportunity where you've got this additional working capital while you still maintain full operational control of your facility. Nothing changes from when that happens, right? In terms of the people are still there. Literally nothing changes but the names on the deeds and that stuff. And so operationally, there's no impact to you, which is obviously important to the residents and the kinds of people that we serve in the IDD space.
I love it. Rick, can you talk in more detail about the key lease terms that folks need to totally understand? Because the terms are where a lot of the important details live that impact a lot more than people often think.
Well, exactly, Sam. And once the sale leaseback happens, right, the lease is like the controlling document in the relationship moving forward. So it's pretty critical to understand what those items are. And in typical terms, if you're looking at the bottom of the screen, we have a triple net lease versus a gross lease, and then there's ranges in between that where anywhere from who's sharing the expenses of it, who's paying the expenses of the house. And the triple net lease oftentimes is your most affordable lease to the provider, but the provider is responsible for all the taxes, all the insurance, all of the repairs and maintenance items. Then it moves in towards the gross lease where you're modifying the lease so that the landlord is covering certain expenses, and we're seeing a lot of that where one of the big benefits to doing a sale leaseback and you create a modified lease is it allows the provider to have a much more predictable cash flow. We're knowing that, hey, you're not going to get hit with a brand new roof to replace on the house. That's built into your lease costs on a monthly basis. You're not going to have to, replace an $8,000 HVAC unit. That's built into your lease basis. So there's a huge benefit for providers in terms of their cash flow, which is kind of obviously one of the key elements that operators are working on a monthly basis to have a manageable, predictable cash flow and of what expenses are going to look like and not be hit with these big ticket items that you can have with houses. The next part is the lease length, which is kind of interesting because providers, from an investor perspective, from our perspective, obviously the longer the term lease, the more attractive that is to us, and any investor for that matter. They want to see a longer term lease. Now, I would caution somebody against going against short term leases where the landlord has all the ability to sort of kick somebody out, where you might get involved with sort of a flipping scheme where you've sold your house to the wrong group of guys that are just looking to flip it and make the profit on the real estate. You want to be important to sort of work with IDD sensitive and investors that understand that space, because these houses are typically used for, as we said earlier in the previous slides, they're long-term stays. They're sticky properties that people stay there for a long time, and so long-term leases shouldn't be a scary thing to consider as a provider. Although some providers that just struggle with that, and so we often do leases at the 5-year basis as well. We typically don't go below 5 years because from an investor perspective, that's kind of about the minimum you need to kind of get the return that makes sense for everybody from a cash flow perspective. So lease term lengths, renewal options, you could probably get as many as you want from most investors. We're often seeing 2 5-year renewals, so it adds another option for you to have another 10 years with the property from the initial term. And then the rent escalators, conceptually, those aren't designed to do anything other than try to match what the rate of inflation is. Obviously, it varies a lot, and some leases actually might have a cost of living CPI based adjustment that happens on an annual basis. So it's really reflective of the time, the specific, inflation rates during the lease period. In most cases, it's usually between 2, 3, 3.5% on an annual basis, and that's at or below the annual inflation rate, sort of historically. And then again, renewal options are what you're looking for to sort of maintain control of your property and the right to do that. I said before, we've done 2 5-year renewals. Actually, we did in a property with a provider that was worried about the relationship and wanted to make sure they kept control of the property. I think they did an initial 25-year lease, and then they did 10 5-year renewals so that they could have control of the property for 75 years. We were happy to do it. Because we understand the long-term nature of these relationships and the properties that you guys are using.
All right, now for the super duper fun part. What do we do with all this money? First, we'll start off by outlining PropCo's uses, and then we'll move into OpCo's.
Yeah, yes, Sam. Just like you expressed, this is the exciting part of the webinar here, in terms of where people get kind of excited, rightly so, because if you have a PropCo OpCo scenario, on the property side, if you want to continue to own real estate and build that, real estate back up, or have some involvement in it because of you like to do that, obviously these are some of the things that happen that you're able to do with that working capital. You can obviously acquire additional facilities, funding renovations, and expanding in the new states with the real estate. Of course, you can expand in the new markets with a partner as well on the operating side. So in terms of hiring and retaining direct DSPs, so that you have that ability to move into markets, or maybe respond to counties where you're getting more referrals, and you can use those dollars to expand into those facilities from an operating side. Use your capital real estate partner to go acquire the house, and you're able to use those your working capital dollars to fund salaries and operating expenses moving into a new market. And of course, it is a market where everybody's aware of the lag in terms of getting repaid. So you kind of need that level of working capital to handle that 60, 90-day, lag from the time you're delivering services to the time you actually get reimbursed from your state and the Fed. So, those are obviously the straightforward, simple ones, obvious ones you can do. Obviously, in terms of just the ability to build cash reserves and reduce on your line of credit could help if you're looking at shoring up EBITDA and things like that as it relates to, a potential sale of your company. So those are the kinds of things that you're able to do with putting that capital to work for you.
And then you want to highlight the compounding effect.
All right. Well, of course, obviously, as you can see, their capital reinvested in operations, obviously builds, creates more revenue, and through increasing your census, you're able to, better staff retention through expanding your programming and whatnot, and then you're adding additional revenue you can further your growth. It's a cycle, and it starts with unlocking the equity that's in your real estate.
I love that part. Thank you for explaining. And so the key point here is that this isn't just about getting a check, even though that we really do like that part, but it's about being able to execute on a strategy that can truly benefit your organization. And that is a conversation worth having with your leadership team, with your board, etc. So I love a good sale-leaseback, but it's not always the right move for every organization nor every situation. So it's really important to note that there are some inherent risks and considerations that your organization has to analyze, just put quite frankly. So we're going to walk you through the real risks.
Yeah, obviously, the main one is, of course, you're no longer owning the asset. It's something you've given up that equity. You've traded that equity in the real estate for actually real cash into your balance sheet. In the future, should that property increase in value, that increase in value, the upside of that goes to the investor, who, depending on the exit of your lease, could be realized something 10, 15, 25 years from now. They're going to be able to realize that value. Again, back to the lease terms, they really are going to define and determine everything. So it's really important that you have a properly structured lease, because if you don't, it could really constrain your growth, and you realize you don't want to give up control just for a short-term capital. You want to be able to think about this in the long term. And then generic health real estate advisors may not understand the IDD nuances. And that's where I mentioned before, it's important to sort of work with an IDD specific advisor. Whether you choose to do it or not, you want to make sure you're talking to somebody that understands this space, understands the nuances, has kind of got a heart for it in the sense that understands that in this space, it's about patience. Again, back to the reason IDD investors like it is because of that. It's a long-term relationship that you build with providers, and you're not looking, to be kicked out of a piece of real estate while the investor flips it in some cases. So that's why it's important. Obviously, lease becomes a fixed operating cost. So just your stable revenues, right? So historically, if you've got a nice track record for having a stable census and you're not having a lot of turnover, that sets things up nicely for you in terms of where this might be a consideration. If you have a lot of fluctuations going on, then maybe it's a cause for pause to take a look at what that looks like and how you might be able to fix that. There is the Medicaid reimbursement stability. Obviously, we're seeing a little bit of that in this world today, where you're looking at Medicaid rates are changing in some regards, and the rules are changing. So it might make if a reduction, a 5% reduction in Medicaid rates creates a real difficulty for you to meet a rent obligation, because that's now become a regular fixed fee, then that makes this thing hard to carry. So you want to make sure you model things accordingly. And then long-term lease, we say a 15-year lease because I think our average is about 10 years. But we have plenty of 20-year leases, that properties that have been in there for 20 years, for 20 years. So this is a long-term commitment, whether it's 5, 10, or 15 years. You want to make sure that ideally you're in a location that you want to be in, where growth looks like it's going to be somewhat consistent for you, and you're going to get the referrals you need and the stable workforce.
Thanks, Rick.
Yeah.
All right. So as with all good things, they must come to an end, even though I think Rick and I could yap about this for 3 more hours. But as we come to a close with at least the content portion of today's webinar, we want to make sure that we leave you with a simple assessment with 5 questions that we'd encourage any provider in any space, not just the IDD space, to ask before exploring a sale-leaseback. Rick, can you give us a quick rundown?
Sure. Let me just run down these real quickly for everybody that we talked about. And that is, obviously, you need to own your facilities outright, and those facilities need to carry some equity in them. And that's obviously, you can find that out through looking at your market value versus your book, and where your total property equity sits in. And then you want to look at your census and see if your Medicaid payer mix is defensible. Long-term lease obligations require some predictable revenue. And if your occupancy fluctuates or you have significant reimbursement challenges, then you want to address those fundamentals first. And then next, the third is about your growth plan. If you know exactly where you want to do with that existing capital, and you're expanding into new markets, to acquire more facilities, to invest in your workforce infrastructure, then that's a strong indication that the conversation could be worthwhile. And this fourth point, are your operations strong enough? Stress test your financials. Model what happens if your rates are flat or if your census dips, and what does that do to your lease payment, and is it manageable? I mean, what if you have an increase in costs in other areas? If the downside scenario is manageable, then that's a good sign as well. And then lastly, if you have a good relationship with an IDD real estate specifically investment company, if you don't have one, we think you should start building one even before you might need it, because actually what having a relationship and a standing relationship with a capital real estate partner will allow you to do obviously you're not forced them to do anything. It gives you a lot of options. Say an opportunity comes along to acquire a local provider that's in your neighborhood that just makes a lot of sense. The real estate part of that could be the thing that actually helps to fund the OpCo acquisition in some regards, doing a sale-leaseback without going to another bank, another investor group or something like that. You may not choose to do it, but it's just a tool in your toolbox so that you can have the flexibility to respond quickly. Maybe you have, again, you've had a lot of referrals in one of your particular counties, and it looks like you can move quickly. Acquiring a home and opening it up for a real estate capital partner is, in some cases, it's less than 30 days. So it allows you to really be nimble and quick in responding to the needs in your particular regions that you're in. And that can't be bad. So anyway, that's a great reason why to have one. Again, you're not required to use it at any particular time, but it'd be great to have that relationship. And if you've answered yes to any of these or most of these items, it's probably worthwhile having a conversation. If you've answered no to a number, say half or a number of these, then that's fine too. You kind of know where you stand, and maybe there's some things you can work on your in your operations to shore that up. And of course, if it's no, it's no. So, but this is we think it's a meaningful exercise for providers to go through. And for us, we're happy to help you in any way possible. So that's kind of what we're about. So we've been in this market for 26 years. We say real estate ownership is not a virtue. We think capital deployment is. So if we can help you in any way, this has been a pleasure for us to be here today and present. So we're eager to be of service.
Yes. Yeah. Thank you all so much for spending this hour with us. And more importantly, thank you for the incredible work that you do every single day to support the community that we care about so deeply. So if you have more questions, because we've got plenty more time. So if you have more questions, comments, complaints about Rick, etc., give us a shout. Our emails are also on the screen, but feel free to drop something in the chat as well. Are you able to share the slide deck? Absolutely, Brad. I'll send that your way. But if you have any more questions, please do fill them in the chat. We'll wait for a few more minutes. But yeah, it's been an absolute blast. Thank you, everybody.
Thank you.